Okay, so I'm back here in the basement of my office on a Saturday morning, dressed to impress, and I had a situation yesterday that happened, and I found this amazing whiteboard in this empty office. I will probably get in trouble for this, but you know what? I'm a good tenant, so I don't think they're gonna kick me out. So this is fascinating. This is a classic mistake that you need to be aware of when it comes to partially self-funding. So you have full self-funding, right? Which the big companies have. Basically, there's very little insurance in that model. So Walmart, companies with thousands of employees on the medical plan, that's full self-funding. That's not what I'm talking about. What we are deploying a lot right now is what's called partial self-funding. And in that, and even a step further, is something called a custom health plan. I won't go that deep. Partial self-funding has insurance layers to protect you so that if you have a big claim or cancer or a big pharmaceutical drug, you have some protection. You're not funding the claims out of cash flow, which most companies can't do, right? This is a classic mistake, and hopefully you'll be able to see this on this board since I'm by myself. But I think the point is what's important, not the quality of this video. If you look at the spend on your medical plan, and I'm just gonna give you some round numbers, real life, but round numbers, okay? So, and I brought my sheet from yesterday, so I have these exact figures. So here's a company that was spending $763 per month per employee only rate. All right, so hopefully you can see that, 763. So that is the agreed upon fixed rate once you bundle all the insurance components together. And that's what's being charged when you add up all the layers, the different components of the supply chain. Now, if you have a family on the plan, that number is different, it's higher. And there's a factor we use depending on family, child, spouse, whatever. But I'm gonna keep it simple, employee only. Of that rate, the administration of that, I'm looking at my notes here, okay. $65 per month per employee. That's the admin. So what's admin? You have admin, you have insurance or reinsurance, you have claims funding, and that's essentially it. You know, there may be a fourth one, but just to keep it simple, you have administration, which is an administrator that manages your money. Forget about the cards. I hear this talk about, oh, they print the cards. They do, but you're not paying them to print cards. If you are, you're getting ripped off. They manage your money in your bank account. This is now an ERISA plan. You as a fiduciary in that company, CFO, CEO, HR, chief HR director, whatever you are, you're a fiduciary onto the money, just like your 401k plan. So under ERISA, you're watching out for that, and this is your money being spent for processing what? Claims. Processing claims. So, okay, so if this is what I'm spending per month, what are the other fees? And so actually, let me keep going. So what are the other pieces? So you have claims. And let me check my note here, okay? Here's your claims. It's called claims funding. You guys see that? So $442 a month is going into this pot for claims. $65 a month is going into this other little pot to watch out for who's paying the claims. And then the last piece is insurance. $256 a month for employee only goes into this insurance bucket. All right, that's money in there. You have claims and you have admin. And if you add that up, it is, first thing in the morning, I need to cheat a little bit, $763 per employee per month. All right, apologize for the poor quality of this video, but the content is what's important. I'm not trying to make it all fancy, obviously. $763 a month is what you're spending. What percentage of that money every month is used for admin? This divided by this. 65 divided by this is the percentage of the total spend you're using for administration. 9%. How much is this plus insurance compared to the total? There's only two more components. So hopefully if you've got at least a third grade math education, which my kids are learning right now, the remainder is 91% is everything else. So here's the thing you need to know. This is the punchline. I'm on a call yesterday and I was talking to them about their partially self-funded plan, and they said they switched their administrator. The other phrase you will hear is third-party administrator, TPA. That's the other word you're gonna hear. Or the administration, it's all kind of the same. So they said we switched our administrator a year ago, and I said, okay, now this is not my client, so I'm trying to help them, and I said, why did you change? Well, they had lower fees. The broker said they had lower fees. Okay, normally in healthcare, that would make a lot of sense. They have lower fees, yeah, we want to use them. They have lower fees. Have you connected the dots yet? Maybe not. Let me just, I'll give you a little, because I had to kind of stop and make sure that this point came across. I said, I hope to work with you, but even if I don't work with you, I'm here to educate you on what is happening, because you are a fiduciary on the plan. And if you're being told something and I hear that and I disagree, I'm like, that makes no sense. I'm gonna tell you. I'm not saying that people were bad people. I'm saying the information is wrong, that the guidance is off, and I'll show you why, common sense why. If this is your admin fee and you're like, yeah, the administrator was too expensive, so we wanted to save money. We wanted to save 10% on the fees, right? I don't want to pay $65 a month per person. I want to pay $59, which is 10% less. 10% less. Let me see if I can do this. This may not. Great, you're gonna save 0.9% on your total healthcare spend. $500,000 you're gonna save with that move, 0.9%. Does that make sense to you? Well, John, it's still money. It's still $6. It is $6 per employee per month, every single month, every single year. You're right. You're right. What's the role of these guys? What is their main job? To watch your money. They pay claims that are valid from your cash flow. Your money and your employees' money, right, collectively goes into this pot, a separate bank account, and then they pay it out of your account on your behalf. And there's a whole different subject about TPAs that I'm not going to go through, but I'm just trying to make a very simple point. We wanted to save money, and so I said, great, what are they doing to control the 91% of your spend? What are they doing to control the biggest piece of the pie? Well, we have this, and I think we have a specialty carve out, and I don't know who the PBM is, and I didn't know. It's like, okay, I'm here to tell you, at least teach you what they're doing. So then I said, what's your renewal, what's your increase history been on this partially self-funded plan? And just by looking at their current year-to-date claims funding, they're going to be projected to be in a deficit of $30,000. It's about 10% deficit from their spend, a little under 10% of their spend. And they said, well, yeah, we've had increases every year. And I said, what are the reasons why? Well, costs are going up, and we had some big claims, which is why they went up. Yeah, you're going to get big claims. But those people probably won't be on our plan because they're kind of getting better now, so they'll probably come off, so it won't be as big a deal. Like, stuff's gonna hit your plan eventually. It's not if, it's when. Don't try to be like, well, they're healthy now. Yeah, but tomorrow you hire a new employee that has a child that has Crohn's disease, that gets on your plan, gets your pharmaceutical plan, and gets a medicine for Crohn's disease that costs your plan 18 grand a month. I have a video about it. Out of the blue, you get a new hire. Ooh, but he only paid $70 copay. Yeah, but your plan paid $18,000 a month. What are you gonna do then? So this is your spend. And I usually say 80% of your total healthcare is claims. In this case, it was 91%. So saving 10% of 9% is less than 1%. Save 10% of 91% is 9%. This is a 9x return on your effort. The point, make sure you're educated when it comes to partial self-funding. If you're the CEO, CFO, HR, and you have a partial self-funded plan, and again, remember I said the fully self-funded plan is the really big, and the dynamics are very different. So if you have over 1,000 employees in your plan, your dynamics are probably very different. So this may or may not apply directly to you, but all the companies I'm talking to now have between 50 and 500, or 50 and 1,000, right? 50 to 250. The SMB market, the small mid-sized market that have been left out of these strategies. Why? Vendors wouldn't work with you. They couldn't. You were too small, too risky. You're like, I don't want to take on 70 people. You're not credible. One claim blows it up. So technology's changed that, underwriting's changed that. The last 3 years has been a huge shift. And if you're like, I've never heard of this before, you're right. And that's why you're hearing about it now, because it's now available, but it's the things that have already been used in the big companies. You're not a guinea pig. So make sure you understand this stuff. I know some people are like, I hate math. Yeah, you hate math, but you have a legal responsibility to at least understand, we're not gonna change our TPA to save money. No, and you push back. Oh, well, you said you wanted to control your costs and blah, blah, blah. And you say, yeah, what are you gonna do to control the frequency, severity, and magnitude of my claims? What are you gonna do? Write this down, ask them right now, send them an email, send your advisor. What are you gonna do to control the frequency, severity, and magnitude of my claims? For all you CFOs out there, hope you have a good sense of humor. If you want a mug, let me know, I'll send it to you. Hope this is helpful. Check out my other videos. I am on a mission. That's probably a strong word. I am passionate about educating people about this stuff, because in the past I was burned big time. I was burned by something called a non-embedded deductible. Like, what the heck's that, John? Whole other story. I was burned. We were personally burned in our family by selecting an insurance plan that had a non-embedded deductible, where I thought my deductible was $7,500 and I'm done. Because I'm pretty healthy. It was $15,000 because my wife was on the plan. I'm like, who told me, oh boy, what do you mean my deductible is 15 grand? Oh, you have to meet the family deductible before yours coverage kicks in. So check us out, millengroup.com. Hope this helps.